Hey everybody, so today I'm excited to cover Netflix earnings, but before I actually go into the shareholder letter, I want to show you guys how you actually get to this because what I really want for you guys is to actually be able to do this yourself and get a sneak peek before you start looking up on YouTube something like Netflix earnings because when I look it up, there's a lot of YouTubers who are taking advantage of this information being fresh and trying to report it first. I'm going to show you how to get to this page. So just in any browser, look up Netflix Investor Relations. Go ahead, click on the first page. Now, we basically go to this Netflix Investors Relation page, and we're just going to scroll down, and we see this nice little banner right here. It says second quarter 2022 financial results. Now, they give us the letter to shareholders. They also give us the financial statements. So the SEC, they could file the 10Q a little bit later. So they do have some time on that. But for now, we do have this letter to shareholders, which is going to be our friend. And when we do click on this, we get this nice little PDF. So that's this right here. And I'm just going to go over this real quick. So right here, they say Q2 was better than expected on membership growth, and foreign exchange was worse than expected. And that's because of strong dollar. So this resulted in 9% revenue growth, which basically would have been 13% if it wasn't for those foreign exchange extremities. So now they give us this nice little chart of revenues. So here I have the prior year's quarters highlighted, so Q2 and Q3. So they did give us forecasted numbers here. So that's what I like about Netflix. They do like to give us forecasted numbers. So if we're looking at revenue, we came in at 7,970. Do keep in mind this information is in millions except for per share data. So right here we got 7,970. That's comparing to 7,342. This might look good, but keep in mind we are in an inflationary environment and this isn't adjusting for that. Also, forecasted for Q3, we're looking at 7,838 compared to 7,483. So if we're looking at this year over year growth, here we're seeing 19.4%, 16.3%, 16%, 9.8%. This is constantly going down as you guys can see, 8.6, 4.7 for Q3. So, growth prospects are kind of diminishing a little bit for Netflix. Now, if we're looking at net income, net income actually came in pretty decent. And we had a pretty decent earnings per share right here. But if we're looking at Q3 forecast, the earnings per share does not look too good. It is $2.14. We are comparing that to $3.19. So we could actually go ahead and calculate the trailing 12 months with the future quarters data. So what we're going to do is we're actually going to get these last four numbers right here, and we could calculate the PE. So we'll do $2.14 plus $3.20 plus $3.53 plus $1.33. So what does that give us? That gives us 10.2. Netflix is trading around 117 after hours, so 117. Divide that by 10.2. It's trading at 217. So 217 divided by 10.2. That gives us a PE of 21.27. Netflix historically has been trading above 30 just because of their growth prospects. So because that growth is coming down, PE is also coming down. So no surprise there. And now let's scroll down a little bit. So Q2 results. Revenue in Q2 grew by 9% year over year. I already said this. And it says this is driven by a 6% and 2% increase in average paid memberships and ARM. So what is ARM? ARM is average revenue per membership. And this is defined by streaming revenues divided by average number of streaming paid memberships divided by the number of months in the period. All right. So now they say we slightly under forecasted global paid net additions in Q2. Oh, you think? They said negative 2 million forecast in the last quarter's report, but we actually got negative 1 million. So, it still sucks. It just doesn't suck as much as they thought it was going to be. And this was actually compared to 1.5 million in the year ago quarter. So that's probably one of the biggest reasons why we're rallying right now. And they are talking about earnings per share. It's 3.2 versus 2.97 a year ago. And they did give us a little thing right here where they did forecast for $3, but they said due to a 305 million non-cash unrealized gain from FX remeasurements on our euro domination debt, which is recognized below operating income in interest and other income. So basically, they're saying that they had a hedge against the euro, and they had this unrealized gain of 305 million, which actually increased the earnings per share by 20 cents. Is essentially what that is saying. So now right here, they give us a little bit more about Q3 forecast. They're saying with the euro falling below the US dollar for the first time in 2 decades, a significant headwind for all multinational US companies. So that is going to be something that we need to watch out for. And they said nearly 60% of their revenue comes from outside the US, and swings in FX have a large flow through to operating profit, as most of our expenses are in USD and don't benefit from a stronger dollar. So if the dollar does come in stronger, we are going to see more headwinds for a lot of these multinational companies. So now they say we forecast paid net additions for Q3 of 1 million versus 4.4 million in the year ago quarter. So this is pretty big. I mean, the last 2 quarters, we got negative numbers, and now they're saying for Q3, we're expected to see positive 1 million in paid net additions. So this is looking a lot better, you guys, and that's definitely one of the reasons why we're rallying. It's because we didn't come in as negative as we thought we were. We're expecting negative 2 million in those paid net additions, but we got negative 1 million. Now we're forecasting a positive 1 million for Q3. Hopefully they don't miss by a million and this becomes zero, So now they're saying 2022 operating margins, they're expecting 19 to 20% throughout, and that's excluding 150 million in restructuring costs in Q2. So scroll down a little bit. So now they're talking about Stranger Things. So it says, in its first 4 weeks, Stranger Things season 4 generated 1.3 billion hours viewed, making it our biggest season in English TV ever. It says season 4 also reignited interest in past episodes, with season 1 through 3 experiencing a greater than 5-fold increase in viewing in the month after the release of the season 4. And just a little side note, for example, the show catapulted the 1985 song Running Up That Hill in the top of the music charts. So that's just how much of an impact Stranger Things had. So scrolling down a little bit more, they say near-term focus. Going forward, we will focus on better monetizing usage through both continued optimization of our pricing and tiering structures, as well as addition of a new lower-priced ad-supported tier. So now they talk about advertising. So it says, our lower-priced advertising supported offering will complement our existing plans, which will remain ad-free. Our global ARM has grown at a 5% compound annual rate from 2013 to 2021. So it makes sense now to give consumers a choice for a lower price option with advertisements if they desire it. So we're basically going to get another tier of pricing, and it's going to be with advertising. So, we have a cheaper option. If we're feeling poor, a lot of people are going to feel poor if we do have a recession, or we could already be in one. And if gas prices continue to rise, people are going to feel a little bit poor. They might opt out for this cheaper Netflix that comes with ads. So that's basically what this is all talking about. They also do talk a little bit about their Microsoft partnership. So they say, we recently announced Microsoft as our technology and sales partner, and we're targeting to launch this tier around the early part of 2023. So they're talking about their advertising tier. They are investing heavily to expand their multi-billion advertising business into premium television video. So that's a nice little hint for Microsoft. Now, page sharing. So they say we're in the early stages of working to monetize the 100 million plus households that are currently enjoying but not directly paying for Netflix. So that means you guys, you guys who are just bumming off other people's Netflix accounts. We know this will be a change for our members. As such, we have launched 2 different approaches in Latin America to learn more. So let's take a look at that real quick. So this is that page for that link they gave us. So let's see. So we've been carefully exploring different ways for people who want to share their account to pay a bit more. So in March 2022, we launched an Add Extra Member feature in Chile, Costa Rica, and Peru. From next month, we will launch an alternative Add a Home feature in Argentina, the Dominican Republic, El Salvador, Guatemala, and Honduras. So now they talk a little bit about how this ad feature will work. Honestly, when I read through this, I was just like, okay, they're not really explaining the logistics as well. So let's just kind of read through this a little bit. So it says 1 home per account. Each Netflix account, whatever your plan, will include 1 home where you can enjoy Netflix on any of your devices. So how are they going to do that? I'm not too sure. Buy additional homes. To use your Netflix account in additional homes, we will ask you to pay an extra $2.99 per month per home in all these different areas. So that's the Dominican Republic, Honduras, El Salvador, Guatemala. And it says members of the basic plan can add 1 extra home, standard up to 2, and premium up to 3. So now they say travel is included. You can watch while outside the home on your tablet, laptop, or mobile. And it says new manage home features. You will soon be able to control where your account is being used and remove homes at any time from your account settings page. So that's basically all the information they gave us about that. So it's very vague right now. Hopefully we can get some more details on that in the future. Now let's just scroll down a little bit. So here they're talking about, let's see. Oh, they're talking about debt right here. So they say their gross debt at quarter end amounted to 14.3 billion within our target range of 10 to 15 billion. So with cash of 5.8 billion, net debt totaled 8.5 billion. So now they say right here, we target maintaining minimum cash equivalent to roughly 2 months of revenue. So just giving an example, that's going to be 5.3 billion based off of Q2 revenues. So if we're looking at Q2 revenues, that's 5.3 billion, but we had 5.8 billion in cash. So they do want some buffer before they do decide going into repurchasing shares and things of that nature. So if we are looking at the share repurchase plan, I can go back to the last quarter. So let me just go ahead and do that for you guys. So this is Q1, and right here they talk about their stock repurchase plan. They basically say that company board of directors authorized, let me just zoom in for you guys. So company board of directors authorized the repurchase of up to 5 billion of its common stock with no expiration date. So if we're just looking, they actually did not purchase any stock in Q1 or Q2. So the way that you could actually check for this is you could do a Control F. You could look up repurchases. And we're just going to kind of go through these different ones right here. Oh, oops, I skipped it. There we go. So right here in this nice little thing, it's called the Consolidated Statement of Cash Flows. we could see this little line item. It says repurchase of common stock. Notice that it's blank right there. It's blank right there. So that basically means that they did not repurchase any shares in these last 2 quarters. So you guys, now that I kind of covered through all of this, we're gonna look at the technicals real quick. So if we're looking at the technicals right now, I'm gonna go ahead and zoom out a little bit. So you guys can see this massive gap right here. And you guys can also see that price action is currently above the 50-day moving average. We do have this 20-day moving average that looks like it wants to curl over. So, we could see this golden cross in the moving averages with the 20 going over the 50. But we are at 217.46 right now. So where is that? It's right about there. So we do have a little bit more upside. I would say right at around 228, we're going to see hard resistance. And if we do break above this area, my God, we are going to see one hell of a rally. So I'm going to have to zoom out for you guys quite a bit. And I'm actually going to have to go back in time just to show you the significance of this 228 resistance. So right here, this is where it's at. It's 2018. That's going from January all the way to 2018 in December. So here, this is kind of funny because, this is January. We started right here in January. Where did we end? Well, in December, we ended basically right there. So it basically did like a whole bunch of nothing if you just held on to it. So here we can kind of see this massive gap up that we saw on earnings. So you see this massive gap. You basically see this huge move right here. And then we fade all the way back and we close that gap completely. So you can see that this was a gap up area. This was also major support right there. So just based off these two data points, this is going to be significant resistance going forth. So, where are we right now? We're at 217. We basically have $10.50 something cents till we get to this area right here, that 228 resistance. So, this wouldn't be a bad area to actually take a short position. But obviously, if things go wrong, you're going to want to cover your ass real quick. Now, let's see. Was there anything else I wanted to talk about? I felt like there was, but maybe there isn't. Let's see. You know what? I actually think that covers all of it. So hope you guys enjoyed this video and have a great one. I lied. So here's where I say I told you so. So this is what I wanted to talk about, the expected move. So I did talk about the expected move the other day when I made that Netflix recap video. And if we're looking at Netflix, well, look at the expected move. Look at the high. The high was 217.89. Look where we are right now. So we're basically at the high of the expected move. So just given that information, I think there is a pretty decent chance that we could sell off first thing tomorrow morning. And if we don't sell off, let's say we hold this 217 level, then I do think, it wouldn't be absurd if we just went up to this 228 level. And then, that could be like a decent area to maybe take a short position. But if we do get above this expected move right here, then, we are getting pretty overextended. So do be careful. The upside isn't a whole lot if we're looking at this as hard resistance. Upside is like $10. Downside could be significantly more. So do watch out, you guys. I am kind of expecting that, people would take profits on call options and do all of that. So I am kind of expecting a little bit of a pullback on Netflix. But, that's just my thoughts. Could be wrong. And with that, have a great one, you guys.